A lot of us aren't understanding the power of these qualified retirement plans. And part of the reason is because of our lack of education, and it's like the IRS and the financial system seems to hide things from us. The only thing that they really tell us is you can be putting $6,000 into your IRA a year, and once you hit 50, then you can hit 7,000. Well, whoop-de-doo. So, like, what's that going to do for me? Well, a simple plan, I could be putting more. And a SEP plan, I could be putting more. And there's 401, there's corporate pension plans. And the first four on that list are what's called a defined contribution plan, because we're defining the contribution based on your age. But then there's a little thing called a defined benefit plan that works backwards. It takes your age, takes what you've already added up in retirement accounts, and it says, oh, let's do some makeup provisions. Up to 25% of your income, up to $245,000. And then there's some stipulations. So let's say I'm 60 years old. I don't quite have enough saved for retirement. Great. I could be putting as an expense to the company. The company's doing well, but I need to put more in my retirement account. I would be putting, I helped a little lady, shouldn't tell you this, but I will. And it was Jill. I was help her put $300,000 the last 3 years as an expense to her company and into our investment companies, not iPlan, but an expense to her other companies, and it's tax-free to her. Why would you not do this? It reduces your corporate taxes, and it helps, and you put money into tax-free environments. There are toll roads and there are free roads, and they're really only telling you about the $6,000 thing. So I promised people who came to this class that we would talk about capital gains freeways. And the very first one, and probably the most powerful of all of them, is using your qualified retirement accounts. The problem with the qualified retirement accounts is getting money in. If you're limited to $6,000, that's not big enough for some of us. And so the last few years, Kendall and I have been putting a lot more into a SEP plan. And we're using that. We're investing in real estate. We're doing hard money loans. We're doing other things, but we're doing it in tax-free environments. I hope you see that. Okay. Number two free way that you ought to be taking advantage of, and that is your personal residence exemption. And what that is I can, if I own a house in my name, not in an LLC, it has to be in my name. If I have it in my name and I live in it 2 out of the last 5 years, then I'm exempt from paying capital gains up to $250,000 if I'm single, and up to $500,000 if I'm married. Well, the qualifications are, again, it can't be in an LLC. So I want to use an entity that is disregarded for tax purposes. A living trust. Could I put my home in a living trust, avoid probate? I know I don't get asset protection, but it avoids probate, and still qualify for the personal residence exemption? Yes, I can. Can I use the personal residence trust that Clint talked about? Yes, or a land trust. Those are disregarded entities. So even if I'm putting my personal residence into that, I still get to claim the residence exemption, which means I don't pay taxes on this, or capital gains taxes on it. And then be aware of one other thing, is putting your home into a land trust, a personal residence trust, or a living trust won't disallow your homestead exemption. A lot of you might live in Texas or Florida, or and we'll talk about this on the third day. In fact, I'll cover this in great detail about how to protect your home. But we want to use an entity that will not disallow this personal residence exemption. If you put your home into a multi-member LLC or a family limited partnership and it's there for more than 3 years, then I've disqualified myself. I don't own it in my name. It's in a business entity. I would never put, for instance, my personal residence in a corporation. Then the corporation might get treated differently for capital gains. So that's one free road. Another one I like is using like-kind exchanges. Most of you have heard about 1031 exchanges, but sometimes we don't really understand how that works. And so let me walk you through that real quickly. Let's say I've got a piece of property, I've held on to it for a long time, and I want to now get rid of it. I want to sell it. As long as I'm going into another investment type piece of real estate, then what I would do is I would hire a qualified intermediary. I would go to closing and bring the intermediary with me. And I wouldn't get to touch the money. The money would go into the intermediary's escrow account. And then I've got 45 days to identify a new property and 180 days to close on the property. Now I can list as many properties as I want on this 45-day disclosure, but then I have to use one of the properties on that list, and I could list dozens or dozens of potential properties, but within 180 days, I need to close on it. I would bring the intermediary and his checkbook back, and they would pay for the money, or they would pay for the closing. All of the money that came out of the first property has to go into the second property. Now, there are partial 1031 exchanges. That becomes more complicated if I only have enough money. And it is the value of the property, not how much equity I have in the property. So even if I have a loan on the property, let's say it's a $500,000 property and a $300,000 loan, $500,000 has to go into the new property or properties. I could buy multiple properties. And a lot of people go, well, I talk to people almost every week that say, look, I'm in my 80s, my 90s. I don't want another exchange. So I said, well, why don't you do a 1031 exchange into a REIT, real estate investment trust? You might get 6-8%, but you'll have no hassles. And it's pretty much guaranteed money. Because it's a real estate investment trust, I can exchange like-kind property into that. I would still need the intermediary. It would have to qualify for 1031 exchanges, but I do that all the time. Okay. Freeway number 4 is take advantage of a stepped up basis, which is not the greatest of the alternatives because it requires that you die, but then the capital gains go away, the properties are reassessed, and the kids inherit the property at the value at the time of my death. Well, okay, although it does have the major disadvantage of, I'm sorry, you have to die, sometimes for some assets, it's a really good option. Let's say I've got a farm and it's in multiple properties, and I've got, the farmhouse over here and the bench property in one deed, and the valley property over here and the dry farm property over here. Might I use some of the properties? I could pay the capital gains on some could go into a charitable remainder trust. Some of it, you know what, when I die, the capital gains will go away. And so it's not an option for every property that I do or for every asset that I do, but for some things that you highly appreciated, that's sometimes a really good option, is to just don't gift it to the kids. Simply they get the property when you pass away and the capital gains go away. Now with that, it becomes very, very interesting option. We call it upstream planning. Let's say, okay, my dad is in his late 90s and I gift him Remember, you can gift up to $15,000 or up to whatever the value of my estate, whatever the exemption is. Right now, it's hovering at $12 million. Let's say I gifted him my $1 million property. And I put inside of the will that when he dies, I'm going to get it back. It's upstream planning. I've gifted him. There will be a gift tax return, but no taxes due. The IRS is going to want to record all the gifts that I've given over $15,000 in any one year. I've given him my $1 million property, and in 2 years, when he passes away, I inherit it back with a step up in basis, and I've avoided the capital gains. It's a little ninja tool that we've used. It's actually decades old, but it's called upstream planning. You can also take advantage of opportunity zones. There are certain places the government really wants you to invest in. And they say, if you invest in these and you keep the property for 10 years, we'll wipe out the capital gains taxes on that. So you could be making money on that property. It could be, as long as it's in an opportunity zone, that's a really ninja way also to avoid capital gains taxes. There's family foundations and charitable remainder trusts. Family foundations are not always for the hospital. I go to the Children's Hospital up in Salt Lake. I look at the plaques on the wall. Almost every one of those are family foundations, because the rule is that they have to contribute 3% of their net assets annually or pay a 5% tax. Well, if I'm growing at 15-20%, because it's in a tax-free environment, it's growing, the assets are growing faster inside than they are outside paying taxes. It's a tax-free environment, and I only have to give away 3% in charitable causes or 5% in taxes. Why would I not do that? You see these family foundations set up, and they're building wealth. The owners or the contributors, the trustees, the people that are running can usually take a 1 or 2% management fee out. And so they've got that, and they do charitable things. That's good. I've seen so many good things happen with family foundations. Charitable remainder trust is another great asset protection planning tool. Let's go back to the farm. I've got this $2 million piece of property that I want to, I've got other assets, but I probably wouldn't put all of my assets into a charitable remainder trust. But the way that this works is I would donate the property, I would create the trust, and it's an irrevocable trust, and I would donate the assets to the trust. What would happen then is I get to take an income stream out of this. And the income stream that you have would vary usually between 5 and 12%, depending on the life expectancy of the trust. If I'm in my 80s and I want this tied to the death of the second spouse, and my wife's also in her 80s, it's not going to be around that long. I might get closer to an 8 or 9% interest rate annually. So what that means is every year the assets are valued, and I get to take out my standard set fixed amount. Let's say it's 9.75% out of the trust. If I'm in my 40s, it's going to be 5% annually. So annually, at the end of every year, they value the assets inside of the trust, and I get to take out 5%. If it's growing, however, at 12%, and I'm only taking out 5%, you see how it continues to grow. What happened when I donated the assets to that trust? Not only did capital gains get wiped away, all recaptured depreciation, virtually all taxes that are due get wiped away when I've donated the asset to the trust, and I get a tax deduction. Now, it won't be 100%, again, because the Girl Scouts or the Boy Scouts or whoever you listed as a charitable beneficiary isn't going to see that money for a very long time. But again, it'll depend. Your charitable donation for that year will be again, based on the life expectancy of the trust. But I love charitable remainder trusts because they provide an income stream for the rest of my life. And at the end of my life, yes, whatever's remaining in the trust is going to go to charity. But what I could do is I could name the family foundation as the charitable beneficiary. Oh, I could use the tax donation that I get in the income stream to pay for a life insurance policy for myself. Oh, and therefore the kids aren't disinherited. They get the life insurance money. The charity gets whatever is remaining in the trust. I got an income stream, and I got the tax deduction and the wiped out, excuse me, capital gains tax. So I love charitable remainder trust, but only on highly appreciated assets. And they have to be substantial enough to warrant having a tax return for the CRT annually.
Oh, that's another gesundheit right there. That's common.
Oh, excuse me. Okay. So I love charitable remainder trust, but I compare it to my 4-foot pipe wrench I have in my garage. I love my 4-foot pipe wrench when I need a 4-foot pipe wrench, but I don't use it under the sink because it doesn't fit. I don't use it for measuring things that are 4 foot long. I don't use it as a hammer. I use it. It's a select tool that's a valuable tool if it's used in the proper way. And the last thing, we're using exchange traded funds rather than mutual funds that don't pay capital gains taxes. But I love buying and selling ETFs. I don't trade mutual funds anymore because I don't like paying capital gains, frankly.